I'm super bullish on the miners. I think
All right.
it's been a choppy start, but they look very good. I think GDXJ can get to 100, probably 100 plus. SILJ, which is junior silver, can get to mid 30s. And again, I think those are minimum targets, not
But
unrealistic targets. I think silver and gold in the miners probably trade beyond the top in the stock market. They could go on for a few months after that.
Breaking news on precious metals and financial markets. Here's what you need to know. Today, we delve into critical insights from Gregory Mannarino, a well-known analyst often referred to as the Robin Hood of Wall Street. Mannarino highlights pivotal financial indicators, including the Dow to gold and gold to silver ratios, to emphasize silver's undervaluation and its role as a vital asset for financial independence. According to Mannarino, a 1-to-1 parity between the Dow and gold is possible, alongside a return to a 15-to-1 gold to silver ratio. In a full-blown financial crisis, these ratios could become even more extreme. He describes the global debt market as a ticking time bomb, with central banks driving the bubble through continued asset purchases and anticipated interest rate cuts in 2024. Mannarino predicts that these moves will inflate the debt bubble further while creating opportunities for commodities like silver and gold.
So everybody wants everything to top out at the same time. That's not reality in the markets, as you know.
now gold almost got to your target. You were looking for 3,000 during
Yep.
the melt up, and we got what to about 2,800, Dave.
Yep.
So is this a break to buy? I was thinking we might see 2,400 first.
This is why I said today is a good day, because I think yields, rates, the dollar, gold, silver. I think they're all at their inflection points, and I believe the dollar. I raised my gold price to 3,400. I can't remember when I did that. Maybe back in July, I can't remember, but it was sometime in the last several months.
Okay.
So I think it's going to 3,400 from here. And I think we just had a correction. I hear a lot of talk about 2,400.
Do you?
I don't.
Okay.
Yeah, I don't think we're going back down there.
Okay.
I think this is a trend line. It's not the main trend line, but it's a trend line. From back in February, you connect the dots there, and you're pretty much down on that trend line. So,
Okay. All right. So we're still holding an uptrend in your view, and silver, have you raised your targets from over 50? Because when gold was almost at targets, silver wasn't close to
right,
50. It got to
right.
35. So
Yeah,
are
my
you
target, my
raising the targets there?
yep, my target on silver is up to 75.
Okay. So
So I
where's that going to put the gold silver ratio? Around
I think it takes it
60?
down to 45, maybe.
Okay. Yeah, so we had this big plunge and we're fighting our way back. So you're right, we are at inflection points
Yep.
where markets could reverse what they've been seeing here as of late.
Yeah, and
Uh,
I see it in the sentiment on Twitter and elsewhere.
People are
Everybody's
turning bearish,
They're
gold
turning
and
bearish on the
silver.
metals. They're ready to throw the silver out forever. And
Yeah,
I have to remind them that silver's moved it basically doubled from a couple of years ago, and yet to hear the talk, you'd think it was still down at its bottom.
yeah, yeah,
Silver
yeah.
was $17 back in September of 22, I think.
You know why? Because they didn't buy silver; they bought the shares. That's my
Yeah,
guess.
well, that's part of it is the miners. Yeah, the miners are very
The
disappointing. And
Very disappointing. I mean, best of breed, Newmont
yep.
got killed. GDX got killed. Would you avoid the miners? I know you liked a long time ago liked SILJ, the junior
Yeah, no,
miners here.
I'm super bullish on the miners. I think
All right.
it's been a choppy start, but they look very good. I think GDXJ can get to 100, probably 100 plus. SILJ, which is junior silver, can get to mid 30s. And again, I think those are minimum targets, not unrealistic targets.
Those are melt-up targets.
Yeah, they are, and I think silver and gold and the miners probably trade beyond the top in the stock market. They could go on for a few months after that. So everybody wants everything to top out at the same time. That's not reality in the markets, as you know. So I think because they're coming from farther back, I think they've got a longer runway.
Okay. There is some pretty ugly technical action in some of the global markets. I know you cover U.S. markets, but all the money flow, is towards the U.S. because of elections have consequences. Europe looks weak with what's happening in Germany and France, and China still has its own problems. Any ideas, David? I know you probably think about it. You've given me an answer before that what's going to cause the top is just exhaustion
I think
of the market.
The top in the market, the actual, reversal in the market could just come out of exhaustion. But the ultimate bust that's coming, as I use a simple equation, which is economic fragility brought on by the pandemic. I still think when you look below the surface, the pandemic caused a lot of things to be more fragile, particularly small business, but a lot of things in our economy, not only here.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
Here, but particularly in Europe and Asia, it's a lot more fragile than it was in entering into the end of previous cycles. Then you add to that the leverage, and leverage is probably the biggest key. You've got 320 trillion of global debt, and you've got quadrillions in notional value of derivatives. The debt's leverage on the economic system and the financial system. The derivatives are leverage on the markets. They're going to bring you huge volatility when we run into trouble. So that's what I think is the bust comes from, and it's triggered by, I think, a monetary policy mistake typically is what triggers this stuff, which means, again, the Fed is the one we watch. It's pretty much mirrored around the world. But look at it. Everybody's concerned that the Fed eased too much. You shouldn't have done 50 basis points. Look at the economy. It's fine. If you look below the surface, a guy like Dave Rosenberg, I think, would support this.
Yeah.
If you look below the surface, this economy is not in good shape at all. The government's been boosted to, I think, probably to help the election for Kamala, but and before that Biden. But ultimately, I think that's kind of phony growth. That the private economy is really not in great shape, and yes, the consumer is still in one of those things where, housing prices are up, my equity's up, I still have a job, so I'm going to keep spending. But if you look, I call it the have and have not economy. Half the country is barely getting by. They're worried about putting food on their table.
Yeah, they're using cards.
Yep.
And they're starting to get cut off from their cards.
Yep.
Yeah, and I think, Dave, that you've been great to the upside. Okay, I think that your clarion call is going to be so critical when this thing ends and rolls over, because U.S. households have never been longer U.S. stocks as a percentage of their assets, and boomers have 75% in stocks right now.
Yep.
And they will not have time to recover if we get the kind of bear market you're anticipating after a few more months of doing cartwheels.
Yeah, that's what I keep saying. It's a real paradox. On the one hand, I tell people that we're very close to the end when you look at 42 years and you're down to the last few months maybe. But the runway between now and the end is basically what you would normally take 2 years to get. 40% in the Russell is 2 years worth of returns, maybe, or certainly 18 months. So even though it may all come in the next few months, I caution people. You're near the end. And don't think you're going to be smart enough to get out at the top. On the other hand, know yourself, because people who, and there's plenty of institutions like this too, hedge funds in particular, people who have gotten out in the last few months, have missed this run. I know psychology very well. That's my, behavioral economics is really what is the backbone of what I do. People who get out early are going to be forced back in because the market's going to be so powerful at the end. They're going to, and the narrative that's going to accompany that is going to be, this thing has legs. This thing's going to run for the next 2 years.
It's different this time.
Actually, listen to Ed Yardeni. He's already started that narrative. So what I think is the paradox is that people have to understand time is short to the end, and you're not gonna, nobody's gonna ring a bell. On the other hand, if you can't stay away from the crowd, you're going to be in at the top because you missed it now. You're going to feel compelled to get in later. If you're in now, you can then be a little more say, well, I'm not worried about the last 10%. I'm getting out now. But if you get out prematurely, you're probably going to be coming back in with the last 10%.
While the price of silver is forecasted to rise significantly, industrial demand for the metal, particularly in the renewable energy and technology sectors, remains near record highs. This growing demand might be tempered by a potential global economic slowdown, yet Mannarino urges investors to take advantage of current market conditions. He advises betting against the debt by acquiring real assets such as gold and silver, referring to these as real money. The U.S. national debt, now exceeding $34 trillion, underscores the urgency of his message. As central banks continue to bolster their reserves with precious metals, the Federal Reserve's cautious stance on rate cuts raises concerns about the trajectory of global liquidity. Federal Reserve Governor Christopher Waller's recent remarks highlight the balancing act between taming inflation and avoiding economic collapse. Mannarino also criticizes widespread media manipulation and propagandist narratives, which distract the public from underlying economic instability. He calls for individuals to increase their awareness and safeguard their financial future by focusing on tangible assets and avoiding over-reliance on fiat currencies. In conclusion, while silver and gold remain undervalued, the growing economic uncertainties provide a unique window of opportunity for strategic investment in precious metals. The question now is, how will you protect your financial future in these volatile times? For more updates and insights, subscribe to our channel and activate notifications. Stay informed, stay prepared. See you next time.